It's really difficult to see the drivers of that earnings recovery beyond maybe exporters having numbers flattered by a weak Indian rupee. You know, the macroeconomic data for India is sort of okay, but I put it more as sort of steady as you go. There's maybe a little bit of pressure on the funding side, which is sort of a global phenomenon as interest rates move higher. And also as currencies are weaker, it will have an impact on people's ability to fund abroad.
Do you sense that strength is going to remain with the traditional defensives? You know, one is seeing some positive news flow come in for the pharma sector from the US FDA. So pharma stocks, for instance, have been bouncing back. And IT, like you were as well highlighting, these are stocks which are in an otherwise bleak market sitting at a 52-week high. And this is across the large and mid-cap IT names.
Yeah, for now, I would expect that trend to continue of IT, pharma outperforming, which is really the other side of the weakness we're seeing in the Indian rupee. Now, I think what we've got to be a little bit careful about with both these, and yes, maybe the FDA news for pharma has been a bit more constructive. We are entering a trade war, and it is possible that there's collateral damage to the services names like Indian IT. Maybe there's some collateral damage to the pharma names, although I think the pharma names have been dealing with other issues related to FDA compliance, etc., and probably moving in the right direction away from those issues.
Okay, aside of insurance, you know, you're saying that private banks and defensives have outperformed. If that pocket is something that investors are either ways chasing, where can one find value, or is it really going to be more of the same, where you keep paying premium for growth because at least there's certainty there? Well,
I think if you look at really what I'm saying here is, for now, value is probably in the US dollar rather than in Indian equities if you're trying to protect your capital. And you have a patient approach to this and let some of the conflicts around trade wars, what's happening with the oil price, rising US interest rates, generate opportunities for you. But I wouldn't be recommending that people aggressively add risk in India today.
Adrian, the consumption names in India are not only stretched, but they overstretched both in terms of ownerships and valuations. But that's where all the action is. If I look at the stocks which are outperforming or stocks which are sitting at a 52-week high, they've got anchoring in and around consumption. So do you think one may find some of these consumer stocks? You may hate the valuations there, but for investors, frankly, there is no other option but to own these consumer stocks, because those who bought HUL or Godrej or some other consumer names, I'm talking about both staples and durables, they are the ones who are actually making money.
Yes, but it probably reflects more the dynamics of capital markets and active management. So you have portfolios that need to be invested. There is concern about the outlook for the Indian economy, about earnings. We have a weakening currency. And so the marginal flow has been out of cyclical names, out of domestic names, into consumer staples or consumer defensives. So this is not going into autos, two-wheelers, etc. And it's also gone into the export earners such as IT and pharma. But I'd also say about IT and pharma is perhaps they're moving away from some of the near-term secular concerns that cause the underperformance of those sectors, particularly in years such as 2017. So I think really what we're reflecting here is the dynamic of capital markets, as opposed to a sort of medium-term investment theme.